You hear it all the time, right? Terms like liquidity sweeps and stop hunts. But what is actually going on under the hood when the price makes one of those super sharp, aggressive moves? Well, today, we're going to pull back that curtain on market mechanics and get to the truth about order flow. Let's dive in and see what's really driving things.
And we're going to start with this quote from order flow expert Andrea Cimitan, because honestly, it just cuts right through one of the biggest myths in retail trading. This idea that liquidity is just some neat little pool of stop losses sitting there waiting to get snatched up, it's just not the whole story. Not even close. The reality is so much more interesting. And that leads us straight to the story that so many traders tell themselves. You know the one. That these giant, faceless institutions are out there meticulously planning their every move just to hunt down your specific stop loss. It's a really compelling story, for sure. But is there any truth to it? Let's break this whole myth down. I mean, really think about it for a second. We're talking about multi-billion, sometimes trillion-dollar pension funds, hedge funds, major banks. Are they really spending their time, their energy, their resources to specifically target the positions of individual traders, like us? It seems a little unlikely, but hey, let's look at the actual numbers. So what is this? 5%. What does this number actually represent? Well, according to the Bank of International Settlements, that's the entire slice of the massive Forex market that's made up of retail traders, all of us, combined. In a market that trades trillions of dollars a day, our entire footprint is just a tiny fraction of the volume. So for a huge institution trying to fill a massive order, hunting for retail stops would be like trying to fill an Olympic swimming pool with a teaspoon. It's just not an efficient way for them to get the liquidity they need.
Okay, so if they aren't hunting our stops, what is causing these incredibly violent price moves we see all the time? Well, to get that, we need to move past these simple labels and really look at the fundamental principles of how a market actually works, because at its core, it's an auction.
And this right here is the first major mind shift you have to make. That classic idea of buyers versus sellers in a simple tug of war, it's a huge oversimplification. The real engine of the market, the thing that makes it go, is the constant interaction between two very different kinds of liquidity, passive and aggressive.
Probably the best way to wrap your head around this is with an analogy. Just imagine passive liquidity is the menu at a restaurant. It shows you all the dishes that are available, and they all have set prices. Aggressive liquidity, then, are the diners. They're the ones who walk in, point at the menu, and say, "I'll take that right now," and they consume what's available.
So to put it simply, passive liquidity is basically the architecture of the market at any given second. These are the traders who are saying, hey, I'm willing to buy if the price drops to here, or I'm willing to sell if the price gets up to here. They place their limit orders in the book and they just wait. They are the ones providing the supply.
Now, aggressive liquidity, that's the force of action. These are the folks, and this includes all those triggered stop-loss orders that are hitting buy at market or sell at market. They don't want to wait. They want to get filled right now, and they're willing to pay the spread to accept a worse price just to make it happen instantly. These are the orders that consume the passive liquidity and actually move the price. All right, so now that we have this new framework, let's go back and look at that liquidity sweep again. With this new understanding of passive versus aggressive orders, we can finally see what's really happening during one of these so-called stop runs.
You know, in the professional world, they have a much more mechanical and way less predatory name for this: book sweeping. And the term itself gives you a huge clue about what's really going on. It's not about hunting people, it's about clearing out the order book. And this is the most crucial point. This is the idea that flips that entire narrative completely upside down. The stop losses aren't the poor victims being hunted and swept up. Nope, when those stops get triggered, they become aggressive market orders, and they are the ones that are actually doing the sweeping of all the passive orders sitting in the book.
So this whole process happens in about 4 steps. First, price hits a key level, which triggers a whole cascade of stop orders, both stop losses and breakout entries, that flood into the market as aggressive market orders. Step 2, these aggressive orders just devour all the passive sell limit orders that were resting above that level. That is the book getting swept clean. Step 3, this super fast consumption of orders leaves behind a vacuum, what we call a liquidity void, because all the resting orders in that area are just gone. And finally, step 4, with no orders there, the path of least resistance is often straight back down into that void, causing that sharp reversal that we see all the time. The market is just looking for balance again.
So what does this all mean, really? It means we can start to shift our entire perspective.
We can go from just spotting surface-level patterns on a chart to actually understanding the fundamental market principles that are creating those patterns in the first place.
All right, let's tie this all together. First, we've seen that the whole stop hunt myth just doesn't really hold up when you look at the numbers. Second, we now know that the real engine of the market is aggressive orders consuming passive orders. That means a sweep isn't a hunt. It's a book-sweeping event that creates an imbalance. And finally, getting this gives you a much deeper, more objective, more mechanical view of why price actually moves the way it does.
And that brings us right back to Andrea Cimitan's point. When you look at the market through the lens of order flow, you get this incredible clarity. Maybe not 100% certainty, but close. Because you're not just guessing based on a pattern. You are seeing the actual forces of buying and selling pressure as they happen. You see the cause, not just the effect.
Think about it like this. Anybody can spot a big bearish engulfing candle on a chart, right? That's just pattern recognition. But order flow shows you the why. It shows you the raw data, the footprint of aggressive sellers totally overwhelming the passive buyers, which is the real story that the candle is just trying to tell you.
And so that's the final question I want to leave you with. Next time you look at your charts, ask yourself, are you just seeing a pattern, or are you seeing the shadow that's being cast by the deeper mechanics of the market happening underneath? Because understanding that difference, well, that's everything. Thanks for joining me.